And this is the 2007 moment for the US. And what I mean by that is in 2007, the Bank of Japan said, no more QE. We're going to stop QQE. And here we are 16 years later, and they have, or 17 years later, and they have, almost twice the amount of bonds on their balance sheet. It's the boiling frog problem, right? You just keep thinking it's all going to work out. And then you realize, wait a minute, why am I paying, $18 for a hamburger? And why is gasoline costing $4 a gallon? That's because your money isn't as good as it used to be because they had to print more of it to fund these deficits.
Last Wednesday, the U.S. Federal Reserve announced the scheduled conclusion of the Bank Term Funding Program, a financial lifeline established during last year's regional banking crisis. This decision put an end to speculation regarding a potential extension of the program, particularly given that the underlying conditions that triggered the initial crisis remain unresolved. The Fed confirmed its adherence to the original timeline and concurrently raised the interest rate on new loans from the BTFP until its termination in March. As per the central bank's announcement, the interest rate on new loans will align with the interest rate on reserve balances on the loan date, resulting in a nearly 50 basis point increase in borrowing costs. This adjustment aims to dissuade further borrowing, effectively closing a previously lucrative arbitrage opportunity for lenders. Earlier this month, Fed Vice Chair for Supervision Michael Barr emphasized the program's emergency nature and asserted that its discontinuation is appropriate now that the crisis has passed. However, Mark Yusko, a prominent investor and hedge fund manager, cautioned against the Fed halting its support initiatives, arguing that the U.S. reached a critical juncture last year, akin to Japan's experience in 2006 when it initially ceased quantitative easing. Yusko contends that the Fed will need to employ innovative approaches to address ongoing economic challenges, suggesting a reliance on monetary expansion and continued Fed intervention to sustain economic stability.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
I thought this temporary program would have to be permanent. Look, we are going to re-enter QE. That's coming. QT is over. They're going to go. This was a stealth way of doing QE. Well, this is not QE. We're just lending these banks some money temporarily while their assets accrete back to par, because these are money good, right? The government's not going to default because the government can just go print more money. It's like the old Doritos commercial, crunch all you want, we'll make more. And I think the problem that I see here is 30% of bank equity. And, we had, was it Jim Bianco? Somebody we had on the show last year who had the great chart of bank balance sheets. And it had the green as the assets and the red as the liabilities and the gold was the equity. And, assets equals liabilities plus owner's equity. That's how accounting works. Well, the problem is if you bought these assets and they became impaired because you bought them at low interest rates and interest rates rose and now there's an impairment, the way the accounting works is those unrealized losses are part of equity. Well, but if they're losses, then shouldn't they detract from the equity value? But the thought is, well, but they're not real losses. They're just unrealized because they're going to be money good. And that's somewhat compelling as long as there's not a bank run, right? Because the challenge for all of banking, fractional reserve banking, and, Caitlin and others rail against this all the time, is functionally bankrupt. It's a bankrupt business model, right? If everybody showed up to the bank and said, I want my money, you couldn't satisfy the demand and the bank would be out of business. And so time is your ally. It's like the opposite of the Maverick scene, right? Time is your greatest enemy. Time is your ally. Because if you can be given time to not have to pay out the depositors, or that's why you shut your doors or to do a bank holiday. But I so long-winded way of saying I didn't expect them to stop this. But what we did see is the bank balance sheet, the Fed balance sheet ticked back up. So they were actually reducing the balance sheet like he said he was going to a year ago, and that's over. There was a tweet going around yesterday on Twitter about Ray Dalio talking about this, that functionally what happens when a currency starts to devalue is government essentially has to go print a bunch of money in the central banking facility and buy up all of the excess bonds. And, you've been talking about this for a while with this wild deficit spending. Everybody was celebrating yesterday, the great GDP number in Q4. Like, sure, give me $500 billion. I'll show you a good time too. $500 billion spent in Q4 that we didn't have. Yeah, you can make GDP look really nice. So fiscal illusion is similar to monetary illusion. And it's the boiling frog problem, right? You just keep thinking it's all going to work out. And then you realize, wait a minute, why am I paying, $18 for a hamburger? And why is gasoline costing $4 a gallon? And why is that plane ticket costing $700 instead of $300? That's because your money isn't as good as it used to be because they had to print more of it to fund these deficits.
The Bank Term Funding Program was introduced amidst the regional banking crisis that saw the collapse of the second, third, and fourth largest banks in U.S. history. Experts, including Yusko, argue that the program offered only a temporary fix, neglecting the underlying issues that precipitated the crisis initially. As the program approaches its conclusion in March, Yusko and others caution that the regional banking sector may face another crisis, one with the potential to rapidly spread to other sectors. This concern prompts the founder and CIO of Morgan Creek Capital to anticipate further monetary stimulus in the future. Let's return to the interview.
And Andy talked about this, I think he even tweeted it, that there was an auction that was bad. It wasn't failed. It wasn't a tail because those primary dealers have to buy no matter what. But if you ranked it between, 4 and 9, it was a 4. I mean, it was ugly. And so does that mean the end of the world? No. Does it mean that we're reaching a point that is, again, unsustainable? Yeah. And everyone's seen the chart, and I wish someone would fix the chart crime. You can't show a 40, 50, 60-year chart in linear scale. You just can't do it. It's so egregious. And what it shows is, here's the interest on debt, and then the expectations in the next 3 years, it goes totally vertical. No, because the difference from going from 0 to $1 trillion is very different than going from 1 trillion to 2 trillion. It just is. And yes, that next trillion is a lot, but the percentage growth is not the same. And so they just need to fix those charts. But things that can't happen won't happen, right? So if we're at the point now where the interest expense as a percent of the budget is reaching the upper bound that it's never reached, that 21% level. So well, why won't it go to 30 or 40 or 50%? If rates are higher today and we got to refinance all this debt that was, has 0 rates or 1% rates, and now it's going to refinance at 4 or 5, then the interest rate is going to go beyond that. Nope. I mean, they'll either, right, buy the bonds and retire them, right? Do some sort of debt jubilee. They will lower interest rates, despite the fact that we don't need lower interest rates unless there's an emergency, but there is an emergency. So it's just a different kind of emergency. And in the death throes of empires, this is what happens. And we've been talking about this a lot. And it doesn't happen over a month or a year. It happens over a reasonable period of time. Now, looking back in history, it seems like it was, instantaneous. But it's not instantaneous. But I've been doing a little reading about Weimar. There's some scary similarities, very scary similarities to Weimar. And I'm not saying we're all going to have wheelbarrows of cash. I'm not there yet. But there are some scary similarities. There are.
On September 18th, the U.S. national debt reached an unprecedented $33 trillion, marking a historic milestone. Presently, the national debt has surged further to $34.145 trillion. Representing an increase of over $1.1 trillion in just 4 months. To put the enormity of $1 trillion into perspective, Yusko often illustrates that 1 trillion seconds equates to approximately 31,700 years. To exhaust $1 trillion at this rate, one would need to spend $1 every second for over 3,710 years. The scale of this fiscal figure is immense. If this trend persists, the US could be accumulating trillions in debt within a matter of days. We invite you to share your insights on Mark Yusko's interview in the comments section below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.